15 minutes before Trump posted that U.S.-Iran talks were productive, $580 million in oil futures contracts changed hands in a single minute. That timing, confirmed by trade data reviewed by Fortune, is what prompted Nobel laureate Paul Krugman to use the word treason. The mechanism is straightforward. Whoever sold those 6,200 Brent and WTI contracts in the 6:49–6:50 a.m. window, then held S&P 500 futures on the long side, was positioned for precisely the outcome that followed: a sharp crude sell-off and an equity bounce. Iran's parliament speaker called Trump's peace signal fake news used to manipulate financial markets. And while oil briefly steadied on that denial, traders ultimately priced in the White House version. Prediction market analysts flagged what they called a strong signal of insider activity, as warbet traders netted over $1 million in a similar pattern. The question isn't whether the trade was illegal. That requires investigation. The question is what it means when markets can no longer price geopolitical risk without wondering who already knows the answer. That same Hormuz choke point is transmitting a second, slower shock that crude traders have largely ignored: fertilizer. Before the war, roughly a third of the global fertilizer supply chain moved through the strait, including half of the world's urea, a nitrogen-based input that American farmers depend on for yields. A report published Monday by 35 agricultural industry groups quantified what's at stake. The U.S. food and agriculture sector generates $10.4 trillion in annual value, roughly 20% of GDP, and supports over 48 million jobs. The fertilizer crunch, unlike oil, has no immediate substitute on the shelf. Corey Rosendosh of the Fertilizer Institute noted that fertilizers alone deliver $37 billion in annual wages. A prolonged Hormuz closure doesn't just raise food prices at the margin, it compresses farm incomes in the planting season, exactly when input commitments are locked in. If disruption extends through Q2, analysts expect downstream food price increases to reach consumers by late summer, adding a second inflation vector that monetary policy cannot address through demand suppression alone. The convergence of fuel and food shocks is what gives this episode its stagflation character. Bank of America spending data had been telling a rare good news story. For the first time in years, Gen Z's spending growth had surpassed baby boomers in mid-2025, driven by rent relief and wage gains running roughly 9% year over year. That recovery is now being tested. Gas prices are up 26% year over year, and BofA economists warn that younger consumers, disproportionately exposed to transportation costs as a share of income, may cut discretionary spending before older cohorts do. A Reuters/Ipsos poll confirmed the political arithmetic. Trump's approval rating fell to 36%, a new low, directly tied to fuel prices and the war. The administration is caught between the logic of the conflict, which requires sustained pressure on Iran, and the domestic cost, which is landing on exactly the demographic most sensitive to energy prices. If crude stays elevated through spring, the spending recovery that BofA was documenting through February 2026 may reverse before it fully registers in GDP data.
While the Iran war dominates macro headlines, a different disruption is building in the labor market, one that Silicon Valley insiders say will define the 2028 presidential election more than any geopolitical conflict. Vinod Khosla, the billionaire venture capitalist and leading OpenAI backer, said at the Hill and Valley Forum on Tuesday that by 2030, 80% of jobs will be AI-capable, meaning exposed to displacement. His argument was structural, not that AI will immediately eliminate those roles, but that the fear of elimination will reshape political behavior. The single biggest issue in the 2028 presidential election will be fear of AI, he said, adding that the biggest danger to AI adoption is now politics, not technology. That fear is already generating legislation. New York is considering a bill banning AI from giving medical or legal advice. Florida passed a law forcing data center companies to pay for their own utilities. Perplexity CEO Aravind Srinivas pushed back with a counterargument that most people dislike their jobs anyway, and AI displacement opens space for entrepreneurship. But that framing landed poorly against real numbers: over 101,000 AI-linked job losses in the U.S. since February 2025, according to the Alliance for Secure AI. Epic Games' 1,000-person layoff this week, explicitly not attributed to AI by CEO Tim Sweeney, illustrates the complexity. Even non-AI-driven cuts are now being interpreted through an AI anxiety lens, amplifying the political signal regardless of actual cause. That anxiety is running directly into the next phase of AI monetization. OpenAI is now targeting a share of Google and Meta's advertising revenue, a structural move that signals the company believes its user base is live and engaged enough to sell attention against. At the same time, Microsoft confirmed it will rent a Texas data center that OpenAI and Oracle had dropped, extending its infrastructure commitment, even as investors worry about the pace of AI revenue conversion. ARM took the most concrete step. The chip designer announced it will sell its own AI chips directly for the first time, a break from its historical licensing model, and expects the move to add billions in annual revenue. The mechanism here is vertical integration pressure. As AI infrastructure costs rise and hyperscalers seek to reduce per-compute pricing, chip designers face a choice between staying upstream as IP licensors or moving down the stack to capture margin directly. ARM is choosing the latter, which puts it in partial competition with its own customers. If ARM's direct chip sales gain traction, it reshapes the cost structure of AI inference at scale and forces Nvidia to defend margin on hardware it has so far priced with limited competition. 3 watch points carry the most forward weight. First, the Hormuz situation. If the strait remains effectively closed through April planting season, fertilizer shortages will shift from a financial risk to an operational one for U.S. agriculture, with food price consequences arriving in Q3. If a ceasefire framework emerges before then, oil retraces and the fertilizer shock stays contained. But the $580 million futures episode means that any Trump statement about peace talks will be read by markets as a potential price signal first, a policy signal second. Second, the AI labor narrative. If COSLA's 2028 framing accelerates state-level AI regulation, companies like Nvidia face a political risk premium that doesn't show up in earnings models. Elizabeth Warren's warning that allowing a single company to be the gatekeeper for the AI future is dangerous suggests that regulatory targeting is moving from abstract to named. Third, the monetization race. OpenAI entering advertising, ARM entering hardware sales, and CoreWeave sitting on a $66 billion backlog with 140% revenue growth all point to AI infrastructure moving from CapEx story to revenue story. But the timing of that conversion determines whether current valuations hold. If revenue acceleration is confirmed in Q2 earnings, the multiple compression thesis loses force. If guidance disappoints, the infrastructure overbuild narrative returns with more data behind it.